Hi, I'm Audie. Welcome to the Panic Playbook, your definitive guide on what to buy when the market is absolutely terrified. When red numbers start flashing across your screen, it is easy to let emotion take the wheel. But a prepared investor knows that widespread fear is often the best time to find opportunity. Today, we are breaking down the specific tools and strategies you need to transition from a panicked seller to a disciplined buyer. To start, we have to quantify the chaos using two specific gauges, the Fear and Greed Index and the VIX. The Fear and Greed Index measures overall market sentiment on a scale of 0 to 100, where very low scores reveal that investors are acting out of irrational pessimism rather than logic. Meanwhile, the VIX, often called the Fear Index, measures expected market volatility based on S&P 500 options. And when it rises sharply, it is a clear sign that panic and uncertainty are taking over the street. Timing is everything, and history shows that when both of these gauges flash extreme fear at the exact same time, emotional selling is likely overdone. You are looking for the Fear and Greed Index to drop below 25, signaling extreme pessimism, while the VIX climbs above 30 or even into the panic zone above 40. When these conditions appear together, disciplined investors stop selling into the fear and start looking for high-quality buying opportunities. We can categorize your potential moves into 4 strategies based on complexity and risk level. For those seeking simplicity and lower risk, broad market ETFs like SPY or QQQ are the standard, while high-quality megacaps like Microsoft, NVDA, and Amazon offer slightly more focused potential. If you are looking for advanced tactics, you might explore options strategies focused on selling volatility, or even tactical leverage trades like TQQQ and SPXL, though these require a much higher appetite for risk. Every recovery needs a solid foundation, and the safest first choice is always broad index funds like SPY and QQQ. These allow you to automatically participate in the broader market rebound without having to guess which specific stock will recover first. Once that foundation is set, you can look at high-quality mega caps, strong, large companies with durable businesses, which often recover incredibly well after panic-driven sell-offs. But it's important to note that they carry more company-specific risk than an ETF. For the advanced traders among us, a high VIX makes option premiums expensive, creating an opportunity to sell volatility through strategies like cash-secured puts, bull put spreads, or the wheel strategy to collect richer premiums. Alternatively, you can look at tactical leverage tools like TQQQ or SPXL, which can rebound massively after a panic event. However, you must handle these with extreme care. They are strictly for short-term tactical trades and are entirely unsuited for your long-term core holdings. Execution requires a 4-step process to ensure you don't jump the gun. First, confirm the signal by waiting for the Fear and Greed Index to drop below 25 while the VIX is greater than 30. Second, pace yourself by buying gradually rather than all at once, because you should never try to catch the exact bottom. Third, anchor your capital safely in broad market indexes first. Finally, only start layering in individual stocks or advanced option strategies once that core foundation is firmly in place. At the end of the day, the goal is not some impossible feat like buying the exact bottom of the market. The real objective is to buy great assets when fear is unusually high and valuations become objectively attractive. If you can keep your head while everyone else is losing theirs, you can let panic be your signal rather than your strategy. Just remember, options involve risk and aren't for everyone. So treat this as an educational guide for your financial journey. Investing in options trading involves significant risk and are not suitable for all investors. The strategies and concepts discussed are provided for educational and informational purposes only and do not constitute financial, investment, or tax advice. Before implementing any investment approach, it is essential to consult with a qualified financial professional to ensure it aligns with your specific risk tolerance and financial goals. Past performance is not indicative of future results, and market conditions can change rapidly.